Insights for the informed investor.
Chapter 1. The Buffett Indicator. Let's start with the first indicator, the so-called Buffett Indicator. Made famous by investing legend Warren Buffett, it shows the ratio of the total market capitalization of stock markets to the gross domestic product, GDP, of a country. The Buffett Indicator mainly uses the Wilshire 5000 index to capture the total market capitalization of the U.S. stock market. This index is then compared to the U.S. GDP, which is published quarterly by the Bureau of Economic Analysis, BEA. The Wilshire 5000 index includes almost all stocks traded in the U.S., providing a comprehensive picture of market size. The Buffett Indicator gives us an idea of whether the stock market is currently overvalued. When the indicator shows a very high figure, as it currently does, it suggests that the valuation of stocks is extremely high compared to the country's economic power. This overvaluation could indicate an impending correction or even a downturn. For example, the Buffett Indicator was at very high levels before the dot-com bubble in the late 1990s and before the 2008 financial crisis, both times indicating overvaluation in the stock markets. In both cases, severe market corrections and recessions followed. The Buffett Indicator can also be understood as a long-term early warning system, signaling when the market is overvalued. In the past, it has often been shown that there was a delay of 6 to 24 months after the Buffett Indicator reached a peak before a recession occurred. This is because markets can remain irrational for longer than expected before a correction becomes inevitable. For example, during the dot-com bubble, the Buffett Indicator reached values of over 140%, meaning that stock markets were valued 40% higher than GDP. After this peak, there was a delay of about 18 months before the market eventually crashed. Similarly, before the 2008 financial crisis, the Buffett Indicator also reached an alarmingly high level, and the markets collapsed about a year later. Another important feature of the Buffett Indicator is its ability to gauge investor confidence in the economic future. When market capitalization relative to GDP is extremely high, it indicates that investors are optimistic about future economic growth and corporate earnings. However, this confidence can be misleading, especially if economic fundamentals do not support this growth. In such cases, markets tend to enter a phase of overvaluation, which can then lead to an abrupt and severe correction when confidence wanes. It is important to note that the Buffett Indicator is not perfect and can also give false positive signals. For example, low interest rates and high liquidity can boost stock market valuations without necessarily indicating a bubble. Nevertheless, the Buffett Indicator remains a valuable tool for investors to get a sense of the overall valuation of the stock market and prepare for potential risks. Chapter 2. The yield curve and the Fed's interest rate policy. The second important factor is the interest rate set by the U.S. Central Bank, the Federal Reserve, Fed. When the Fed raises interest rates, it often does so to combat inflation. Higher interest rates mean that money becomes more expensive and less capital flows into riskier assets like stocks. This has often led to market corrections in the past. The development of government bond yields is particularly significant in this context. When we look at the so-called yield curve, the relationship between short-term and long-term interest rates, and it inverts, meaning that the yields for short-term bonds are higher than for long-term ones, it often points to an impending recession. Recently, the yield on 2-year bonds was positive, but has now turned negative, while the yields on 10-year bonds have risen again. This is a warning sign, as the yield curve has reversed. Such an inversion of the yield curve often indicates that economic growth is slowing and that investors' expectations of future economic development are negative. To elaborate further, the yield curve shows the relationship between the yields of bonds with different maturities. Normally, yields for long-term bonds are higher than for short-term bonds, as investors demand a higher yield for the additional risk of tying up their money longer. However, if this reverses and short-term yields are higher than long-term yields, it is called an inverted yield curve. This indicates that investors expect economic uncertainties or even a recession in the near future. The inversion of the yield curve can be caused by various factors, such as the central bank raising short-term interest rates or declining demand for long-term bonds. Currently, we see that yields on 2-year bonds have fallen, while yields on 10-year bonds have risen. This means that investors are again demanding higher returns for long-term bonds, indicating uncertainty and expectations of poor economic conditions. Another important point is the impact of interest rate policy on overall market liquidity. When the central bank raises interest rates, money becomes more expensive and harder to access. This often leads to fewer investments being made, which in turn slows the economy. During a phase of rising interest rates, investors tend to pull their capital out of risky assets like stocks and invest in safer assets like government bonds. This often leads to a decline in the stock markets. The Fed's current interest rate hikes aim to combat inflation, but they also increase the likelihood of an economic slowdown. Chapter 3. The Fear and Greed Index. Another commonly mentioned indicator is the Fear and Greed Index from CNN. This index measures market sentiment and indicates whether investors are currently fearful or greedy. The Fear and Greed Index is a composite indicator based on a variety of market variables to determine overall sentiment. These include, among others, market volatility, measured by the VIX, the put-call ratio, trading volume, demand for safe bonds, the performance of major stock indices, market breadth, and the spread between corporate bonds and government bonds. High greed means that many investors are willing to take on high risks, which often leads to asset overvaluation and eventually to a bubble. When this index reaches high values, it is often a sign that a correction might be imminent because the market is in an overheated state. Typically, during such phases, the market rises sharply as investors take on ever greater risks, driven by the hope of further gains. However, this euphoric market sentiment is often difficult to sustain, as it is usually not supported by fundamentals. The Fear and Greed Index is based on various factors. 1. Market volatility. The index takes into account market volatility, measured by the VIX. Low volatility often signals greed, while high volatility suggests fear. 2. Put-call ratio. The put-call ratio provides insight into whether investors are more optimistic or pessimistic. A high ratio means that more call options are being traded, indicating optimism and greed. 3. Trading volume. Trading volume is an important indicator of investor interest in stocks. Strongly rising markets with high volume are often a sign of greed. 4th, market breadth. Market breadth measures how many stocks are rising compared to those falling on an exchange. A broad market rally is a positive signal, while a rally driven by only a few stocks indicates weakness. 5. Demand for safe bonds. The demand for U.S. government bonds compared to corporate bonds also provides clues about market sentiment. If investors shy away from riskier corporate bonds and instead focus on government bonds, it signals fear. 6. Price performance. The performance of major stock indices like the S&P 500 is also taken into account. Rising prices indicate greed, while falling prices suggest fear. 7. Junk bond spread. The spread between high-yield bonds, junk bonds, and safe government bonds is also considered. A smaller spread indicates greed, as investors are willing to take higher risks to achieve returns. When the index shows high values, it is often a sign that market participants are taking on too much risk and a market correction is likely. It is important to note that high greed in the market has often been a precursor to strong corrections in the past, as investors were increasingly willing to take unreasonable risks. Examples of this include the dot-com bubble in the late 1990s and the housing bubble before the 2008 financial crisis. In both cases, the markets were characterized by high levels of greed, followed by significant corrections when fundamental weaknesses became apparent. Another important point is that the Fear and Greed Index can be used as a contrarian indicator. This means that extreme values, whether fear or greed, often mark the end of a market phase. When greed is at its peak, it could be a warning signal that the market is overvalued and a correction is imminent. On the other hand, if the index signals extreme fear, it could indicate that the market is about to recover. Investors should therefore use the Fear and Greed Index as a tool to question their own risk appetite and possibly adjust their portfolio allocation. Chapter 4. The Price-Earnings Ratio, PE, of the S&P 500. Let's now look at another indicator that is often used to assess market conditions. The Price-Earnings Ratio, Price-to-Earnings Ratio of the S&P 500. The PE ratio is a measure of the valuation of companies relative to their earnings and provides insight into how expensive or cheap a company's shares are. A high PE ratio indicates that the shares are expensive and expectations for future earnings are high. Investors are therefore paying a high price for future profits, which often reflects optimism about future growth. However, during times of economic uncertainty, a high PE ratio can be a sign that the market is overvalued and a correction might be coming. The PE ratio of the S&P 500 is often used as a benchmark for the entire market, as it reflects the average valuation of the largest U.S. companies. When we look at historical PE data, we see that high PE ratios have often coincided with market peaks and subsequent corrections or downturns. For example, the PE ratio of the S&P 500 reached extremely high levels during the dot-com bubble in the late 1990s before the market crashed. It was similar during the 2008 financial crisis when valuations were excessively high relative to earnings before a major correction occurred. Currently, the PE ratio of the S&P 500 is well above the historical average, suggesting that the market may be overvalued. A high PE ratio means that investors are willing to pay more for future profits, which is a sign of optimism that is often not backed by real economic data. Another important aspect of the PE ratio is its dependence on corporate earnings. If earnings rise, the PE ratio falls with a constant stock price, meaning that stocks become cheaper. During phases of economic growth when earnings are rising, a high PE ratio can thus be justified. However, in times of economic uncertainty, when corporate earnings are under pressure, a high PE ratio can quickly indicate overvaluation. In addition to the PE ratio, many analysts also look at companies' profit margins to get a complete picture of market conditions. The profit margin measures how much profit a company makes relative to its revenue. During economically difficult times, profit margins tend to decline as costs rise and demand falls. For example, higher commodity prices or rising labor costs can reduce profit margins. When profit margins fall, this negatively affects corporate earnings, which in turn can lead to a decline in stock prices. Historically, declining profit margins have often led to a decline in market confidence, as investors fear that companies will not be able to maintain their profitability. Currently, we are seeing profit margins under pressure in some sectors, particularly in cyclical sectors such as industrials and consumer goods. This is due to rising costs for raw materials and energy, as well as declining consumer demand. Technology companies are also facing rising costs and possibly cooling demand, which is another warning sign of a possible market correction. Analysts are watching this development closely, as it could be a harbinger of a general slowdown in economic activity. The combination of a high PE ratio with declining profit margins is particularly worrisome, as it suggests that current valuations may not be sustainable. If expectations for future growth and profitability are not met, this could lead to a sudden revaluation of stocks, triggering a market correction. Therefore, investors should take such warning signs seriously and diversify their portfolios if necessary to mitigate risk. Chapter 5. The Volatility Index VIX. Another important indicator is the Volatility Index, also known as the VIX or Fear Gauge. The VIX measures the expected volatility of the S&P 500 and gives us a sense of how nervous market participants are. The VIX is based on S&P 500 options prices and reflects investors' expectations regarding future price swings. A high VIX value indicates that investors are expecting strong price swings, which is often a sign of market uncertainty and fear. In the past, a sudden rise in the VIX has often been a precursor to a market correction or downturn. For example, the VIX spiked sharply during the 2008 financial crisis, reaching a level of over 80, indicating extreme nervousness and uncertainty among market participants. A similar pattern was observed during the COVID-19 pandemic in March 2020, when the VIX also rose rapidly. Currently, we are again seeing a rise in the VIX, indicating that market participants are increasingly concerned. A high VIX can suggest that investors expect major price swings soon, reflecting uncertainties about future economic developments. Another important point about the VIX is that it can be used as a contrarian indicator. An extremely high VIX value can also mean that market panic has reached its peak and a bottom is near. In the past, we have often seen that after periods of extreme VIX spikes, the market would calm down. However, an elevated VIX remains an indicator of increased volatility and should prompt investors to prepare for potential market fluctuations. Summary and outlook. All these indicators together do not give us an exact date for a possible correction or downturn in the stock market, but they do show us clear warning signs. The Buffett Indicator suggests overvaluation. The yield curve is inverted, the PE ratio is high, profit margins are under pressure, and overall market sentiment shows high levels of greed among investors. However, it is important to emphasize that this does not necessarily mean that a correction or downturn is imminent, as no one can predict the future with certainty. Nevertheless, these signs indicate that after such a long upswing since 2009, a correction could be due. This combination should prompt investors to critically review their portfolios and possibly reduce riskier positions. Remember that these are only possible scenarios and not a guarantee of the future. Markets can continue to develop positively, and there are still many unknowns that could influence the course. No one can say with certainty what will happen next, but it is wise to be prepared. It is about staying alert and making informed decisions rather than being driven by emotions. I would love to hear your opinions. How do you see the current market situation? Do you think we are on the verge of a correction, or do you believe the market has further potential to rise? Share your thoughts in the comments. Your perspectives are valuable to me and other viewers, and I look forward to a lively discussion with you. Don't forget to subscribe to our channel if you want to see more of these analyses. See you next time.